Good morning, smarthelping.com here. It's 8:35 on Christmas Eve, doing a half day. So I've got a 10-year hair salon slash barbershop financial model to show you guys. It's been a couple weeks since the last one, so here we go. Now I think this is one of the cleanest, and the cash flow is really tight and simplified, and there's no leverage or non-leverage. It's just one deal that includes financing. If you don't want to finance, you can put no financing. um but let's just start off by building our case. So I'll go through all the inputs with you. So you've got your start year here, Jan 1/18. This is going to define the year that where your monthly model begins. Then we have the scenario input, and for that you've got your three main revenue streams, which is obviously haircuts, add-on services, and add-on products like shampoos or hair care products, whatever. Usually a place has at least two of these three that they will offer. And once you see the revenue base, you'll understand a bit more how this works. But basically, you can have three different scenarios for each of these, and you can put it at low, base, or high, and based on that, it's going to define what your sales numbers look like for each stream. You can also determine the magnitude. So if you put this at high, it's going to be 20% higher, or low would be 20% lower than what your base is. And you could change these percentages to whatever you want to do. Also, you could easily turn on or off each revenue stream. And if you put it off, nothing for that revenue stream is going to show up in the P&L. Then we've got exit. So obviously, you might not be holding this business for the full 10 years. Maybe you only want to do it for 5 years. You can pick any month in the future, and that could be your exit month. It doesn't have to be the full 10 years. And then this exit multiple is just going to be the percentage of your total revenues that you're going to value the business at. And usually there's a whole bunch of different ways to do this, but I just picked the most popular one, which is, what's your total annual revenue, and usually you'll get a valuation of some percentage of that, depending on the industry. You have to put 50% here. It could be a range of numbers. Then we have the financing, which is going to flow to the financing tab. So you just put, if you're going to finance any money, you put it here, the terms, interest rate, and the first payment date that you have on that. We're just putting 0 for now. So that's the control tab. You've got revenue base. So here's where we're going to build our case up. So let's say we'll have, up to 10 different types of haircuts. They don't all have to start at the same time. They can start at different months, and then you're probably going to obviously have different counts over time, and the idea is you want to grow over time. So let's say let's just do type 5, 18. Let's start that rate in January, and let's say per month we're going to do, let's say you've got 3 workers going at 5 per day of that type. That's 15 a day times, let's say 26 working days. So 390 a month. So we're going to say we got 390 of these going a month. And we could slowly increase that by, like, say 10. Hold on one second. Okay, sorry about that. I'm back. So let's increase these by about 10 a month. Let's also say we got one person doing, let's say, 3 of these a day. That's 60 a month. Increase it by 2 a month. And let's say this doesn't start until October of 18. So a small shop, and you can see how there's so much flexibility or pliability in the model that you can really build all kinds of different scenarios. And this gives you a nice range. It could be 10 barbershops you could calculate these values for, or it could be one. Just a lot of flexibility here. So those are the haircuts. You've also got other services like waxing, manicure, massage, anything like that. So let's say we're going to do massages. We're starting at, let's say, build that out in, say, February 19. We'll do, let's say, I don't know, 5 a day. So what's that, 100 a month, roughly. And then we increase that by 5. And then no other services for now. And then also you got products sold. So you've got shampoos, conditioner, skin, nail care. Now what I've put here is there's no place to account for the costs of these. Instead, to make it simpler, you're going to go gross profit per unit. So all you're going to do is put the gross profit you plan that each product can make. And that streamlines the whole thing and goes straight into the model. That way as a cash flow item. Obviously that's not an accounting line, but if you wanted to, you could obviously back into it by assigning a cost to each of them and then having that populate, and then you've got your cost of goods sold. But for this purpose, we're just going to have the gross profit in there, and then that flows as basically a revenue item. So, let's say from probably March on, we'll have these going, let's say, I don't know, 25 a month for shampoo, 100 a month on conditioner, 50 for skincare. And we'll just flatline that for 10 years. Again, you could adjust this for however you want, however you think you're going to, how much you're going to be able to sell. So there's our revenues, and the reason why I'm just picking a couple is so it's easier for you to see, make sense of the P&L summaries. But you could easily fill in all of these. Okay, so here's the Rev 1 tab, and you can see if I demonstrate, look at type 5 for year 1, we've got it at 390. This is at low, 20%. So 312 is 20% lower than the 390. If I put this up to high, it's now going to be way above the 390. 468 makes sense. And it's only going to control this top module. If I want to do the add-on services, let's say I want them all up 10%. Then you see this 100 will become 110. There it is, 116, 21, based on these numbers. And same with products sold. Let's say we want to put them up 50%, and lower or high it would be 100, so it should be 150, which it is. Yep, 150, 75, 38, and then we could put that to low, and now it cuts down 50, 13, and 25 from the initial base. Yep, perfect. Okay, and then you can also just turn these on or off. So I could just, like I said before, you could just switch them on or off, and then they won't come up in anything. And I'll demonstrate that in a second. So there's a revenue. Let's just put them all at base for now. And then we've got our costs. So let's say we're going to build a new salon, so $250,000 for construction and building. Chairs, I don't know, 50,000, and then you've got other equipment. You could just go ahead and itemize everything you plan on having to buy right up front. And then you've got running costs. So this is, again, if you're going to scale out, you might not have a bunch of workers all at once. Let's say we're going to have one. Their monthly cost is, say, their salaries. They might be on hourly, but you could just estimate maybe 1,500, 2,000, 2,000. Then you go up maybe in June. You get a couple more part-timers, 1,250 or 1,200, and you could just fill that all the way out. You've also got in here, so rent. Obviously, rent wouldn't. We don't need a rent if we're gonna have our own building. Utilities, bookkeeping, supply maintenance, outdoor maintenance, insurance, just any monthly fees or costs that you are gonna have. Okay, so we got these all starting in January and then some in June. Then we have CapEx. So this is like expansion. So let's say in 2020, let's say we want an expansion of I don't know, it's going to cost $100,000 to, maybe you're going to get new equipment or get building or bigger building, whatever the case is. You can enter that there and pick the month that it happens. Whatever month you pick, it's just going to flow right to that month, and it'll reduce the cash flow. But you also see it, the items separated out. Then finally, we've got variable costs. So this is, for example, if you have a franchise fee, maybe it's 6%. Maybe they also charge an ad fee of 1.5%, and then you might have other costs that you want to account for. This is going to be directly a percentage of the total revenue. Okay. So we filled in everything there. Now we've got all we need to have P&L. So if we go over to our executive summary, let's see, what do we look like? It looks like we're making first year 19,000 in cash flow before tax. Then 100,000, 30,000, 140, 150, and it slowly goes up as I've got the numbers going up. You see exit valuation of 150,000, which is 50% of that top line revenue. And you've got even a margin here. There's that 100,000 capex I put in. There's no debt service at the moment. So it's saying, well, you put up 800 grand and this is your return for the next 10 years. You can see the return tab. We've got internal rate of return, which is 9%. Now 9% means it's what you have to discount these future cash flows by in order for the net present value of them to equal what you paid out originally in the investment. So the higher this number is, the better, because if you have to discount these at a higher rate, it just means they must be higher in order for you to have to do that. And that's reflected here. And this is like your compounded annual return. Well, not really. It's really what I just said. It's whatever you have to discount these future cash flows at, so that the net present value is 0 when measured against the startup costs. So the higher the IRR, the better. Usually somewhere between 20 and 30% is ideal. And that's going to have a lot to do with the timing of when these cash flows happen. And then we've got amount financed, which is 0. We've got our total cash requirement. It's going to be the same as the total investment since we're not financing anything. And then we've got net cash returned of 640. So this 641 is after the 830. So if you see, we just sum up the positive values, 1.4 million, but if you sum up everything, it's 641,501. Then if we go to our standard return on investment, that's just the amount of net cash flows relative to the cost. So it's saying you put up 830, you've got $640,000 more than that now. So it's 77% return on investment. 10 years in operation, that equals your ROI of 7% per year, or an average of $64,000 a year. And I like to put these dollar values because you can really see, okay, I put up this 800 grand, I'm going to make $60,000 on average for the next 10 years. And that's assuming you get that's you assuming you get the 800 grand back. So it's like you put the 800 grand in, you get the 800 grand back plus a $64,000 a year. So this is like your profit or what you make on top of your investment. Then we've got break-even month, month 88, break-even year, year 8. So it takes a while to cover up this $800,000 cost, but you can see year 8, 4, 5, 6, 7. You can see year 7, we've still only made $786,000. So in the year 8 and now we've covered it. And these are all dynamic. So there's your high-level summary. We've got some charts here. We've got 3 charts. So this one is just a high-level revenue, expenses, and EBITDA. And then we've got revenue by type. So you can see this is your haircuts. This is your total revenue of other services like your massage. And then this is your revenue of other products like hair care, nail care, what have you. So you can see that nice and easy. Now this one's a nice colorful chart. We got a monthly cash flow versus accumulated cash. So the blue line is your monthly cash flow, and this yellow is the result of all these cash flows. You can see obviously it's slowly going up at, what are we doing, 10,000 a month, 11,000, 11,000. So it's slowly paying back this 600 and, well, however, $830,000, slowly taking away at it. You can see here during that capital expenditure of 100,000, we go backwards a bit, but it still is going up, and we end up with a net cash position up here around 400,000. Now here's your monthly charts that I talked about. So you've got the granularity of all your revenue streams. So you've got each haircut type, how much you're making per month on all of those throughout the 10 years. You've got your other services, which you didn't start until Feb 19. And then we've got some other products sold, shampoos, conditioners, and that's going out. So based on that, you've got total revenue, variable costs, net revenue, monthly running costs, your EBITDA, CapEx, cash flow after CapEx, debt service, cash flow after debt service. You've got the exit value line, the loan payback, financing cash flow inflow, startup costs, monthly cash in and out, and then cash position and break-even month. You can see that. Oh, there it is. All right, there's April 2025. Now I've grouped all these so you can easily toggle this and see just the main line items instead of seeing, you know, all the hundreds of rows in between that create them. So it gives a bit of an easier view. You can just toggle right out of that. And then the annual does the same exact thing I just showed you, except for it's only, you know, it's showing 10 years worth of time, you know, 1 year at a time instead of by month. And so you see we're making $84,000 a year on the haircuts, $75,000 on these services, about $11,000 on products sold, 12, 13, and then the aggregate of all those three is here. Variable costs, same exact thing as the monthly, but it's just annual roll up. Oh, and then down here I did do a discounted cash flow analysis. Right now this is a negative because at that discount rate, the future net present value of these cash flows is less than this. You can see, yeah, by 400,000. If we put the discount rate down, let's say 5%, now it's positive because we're not discounting them as much. So this is just a nice little add-on here on the annual summary you could play with. Now if you'll see, if we look at the control tab or the executive summary, if we put in this IRR, Remember, this makes the future cash flows net present value equals 0. So if we go to our annual and put that into our discount rate, the future cash flow of these, the net present value of these should equal 0 against this 830. So let's see if it is. And yeah, look at that. 0 net present value. See, 0. So zeroed it all out. So that's a nice checker there, just to check your IR. And this is actually net present value, because it's taking the net present value of the future cash flows against the startup cost. So I'm just summing up that whole row. Now, if it's just the net present value of future cash flows, it'd just be these. So it'd be actually $1 million. But you measure that against your startup cost, and the discount rate is going to define what that is. Okay, then the financing final tab, this is just a loan schedule. All this feeds in from the control tab. And let's look at that real quick. So here's our internal rate of return of 9%. Let's say we don't want to put up 800 grand. Let's say we want to finance some of that. So let's say 400,000. So let's say we take out a loan for 400,000, a long-term loan, 30 years, in January, to pay for some of this stuff. Oh, shoot! I dropped my mic. All right, that's okay. So 400,000. Now look at the internal return. It's 11%. Went up a bit because we only had to come up with 400,000. Now our cash flow is actually down a little bit since we have that debt service line now, 30,000 a year. But we didn't have to come up with $400,000 at the beginning, so that helped. And then we had to still pay that back. There's still obviously a balance of 340. So at the exit, that comes back off. So that's why this is negative, even though we do have an exit here and cash flow from the operations. And this is often the case is a franchise business or any kind of business really that it's a couple shops. You might not get a valuation that's equal to more than what you'll make in a year on the top line or on the bottom line. So you can see here 185,000 on the bottom, and you're only valued at 150. So some guys, hey, they stay in business another year. They just got what they could have sold it for. Now, if you get a higher valuation, maybe 75%, that cash might be meaningful enough to you that you want to get out now. Just depends. So that's where your financing, that's kind of the effect of financing will have on your internal rate of return. It should improve it. And charts a bit different here. You see the P&L, the debt service is in now, 30,000 a year. You see the interest goes down over time, principal goes up. Now, let's see here. Let's turn off one of these. So let's see if we turn off our add-on services, what it looks like. So you can see now this add-on services is completely zeroed out. All blanks. We're now at a negative internal rate of return. We don't even make back what we put in if we take that revenue stream out. But if we put that off, maybe put this up to a high, it's still negative. And let's put this up to a high. That's still negative. That's okay. Let me turn it back on. Put these back to base. Let's give it 100% exit value, 300,000. I got 13%. Okay, so I think that's everything I need to show you. Let's do a couple more of these. If we put this at, say, 50, 100, 150. Let's say we start these in May. We have some more here. It's 25 in April. Let's see how this looks. So there you can see the granulation of one revenue stream starting later on. Same here, starting in Feb. And that earlier one. And those I didn't change. But you can do a lot with this. It's just very flexible, very clean and easy to make sense of. Let's see, I'll drag these out just for the template. Got instructions, index for a quick tutorial. So if you want this model, I do sell it. It's going to be a intermediate level on smarthelping.com, and the link will be in the description box below. This will be just a one-time cost of $75, and you'll get it automatically. It'll be available for download right after the purchase. You can email me if you have any questions, jason@smarthelping.com. And this is our 10-year barbershop financial model. I'll see you on the next one.